This week, we wanted to dig into the question of how to understand the rising volume of debt trading at distress levels. Is this a leading indicator of stress in the U.S. economy, or rather a sign of a healthy market where investors are actually using discretion? I sat down recently with Bill Brady, head of the alternative lender and private credit group at the law firm Paul Hastings, and we spoke about where we are in terms of the balance of deals that are falling apart versus coming to market.
3 months ago, I would have told you it's 50-50. The pendulum's now swung back a little bit more the other way, so it's probably 70% front-end deals, very competitive, highly sought-after deals, and 30% restructurings. But it's really, for the first time in my 20-year career, it's typically 95-5, one way or the other, right? The markets are hot, deals aren't being restructured, or we have a recession 10 years ago, everything's being restructured. This is the first time in my career where we're busy on both ends.
What does that tell you?
From my perspective, I think it means that there's still a pretty good tailwind economically, but leverage is high, the margin for error is low, and so we really have winners and losers in terms of which deals are succeeding and which ones aren't.
There's a sort of belief out there that the pain in the restructuring has been isolated to energy and retail. Is that the reality? Is this just a sector-based problem, or is this something else having to do with leverage and the structuring of deals?
It's more concentrated in those areas, but it is both. And I could close my eyes and pick 10 restructurings off my desk, and it might be 10 different industries. It really is across the board. Now, again, there's more concentration in troubled industries. Obviously, retail is a big one. But with high leverage, if management makes a misstep, they can find themselves back at the table.
Given the fact that it is so prevalent, some of the EBITDA add backs or the leakage, as you talk about, paying dividends, et cetera, do you think that the next cycle is going to be really painful, more so than people are perhaps prepared for?
No, I actually think, well, it depends on which people and which constituents. I think for for some of the shareholders, it may be painful. But there's so much dry powder on the sidelines. There's a lot of distressed funds that have been raised, and they haven't been deployed yet. The cash hasn't been deployed. But unlike 2009, whenever the next recession comes, and I frankly don't think it's coming that soon. I've been saying that for 5 years.
Congratulations, you've gotten it right.
For the last 5 years.
For the last 5 years.
I do think it'll be a softer landing, because in 2009, when the banks pulled back, you didn't have these billions and billions and billions of dollars of distressed debt funds ready to come in, and even other kind of funds, private debt funds, rescue funds. So there was a hard landing for a lot of companies. I think a lot of those borrowers today will have a softer landing, but there's a price, right, for the distressed lender to come in. They're going to be compensated for the risk, and that compensation is going to come in the form of, probably a higher interest rate, probably a huge equity kicker. They're going to take a big piece of the equity. But for the company, and also ancillary to that, jobs, I think, can be saved through that softer landing.
Do you think that private debt funds are going to significantly outperform private equity funds over the next 5 to 10 years, just based on what you were talking about, the dynamic of private equity perhaps being the one that feels the pain much more than the lender?
There are a lot of experts, pundits, talking about the next recession's coming. There's a number of people saying it's not coming. There is still a period of time yet to go before the next recession hits. Now, when that happens, and it always does, right, at some point, I do think the private debt funds will be pretty well positioned in the market, notwithstanding the high leverage, because the private debt funds, many of them have the underwriting capability and the appetite where if they have to own it, they will. They're not in the business of loan to own. They're in the business of lending. But they have the personnel with the private equity background, and this is part of my practice as well. If for unforeseen reasons the lender has to take the keys, they have the capacity. They can bring in the experts. They can turn around the business, and 3 to 5 years later they can sell it and possibly recoup not only their equity but a good portion of their debt.